CVS is a well-known pharmacy company, but what people don't know about the company is they acquired Aetna a few years ago and became a healthcare payer, a health insurance company. And the insurance business is quite lucrative. You collect a lot of premiums, have that cash at your disposal, then you pay on those premiums as an insurance company should. That really changed the CVS business model. What they're also embarking on is providing health services at their locations. This could be urgent care, health services, just, ordinary things like somebody has strep throat or some condition that could be treated just by going in and seeing a doctor, getting a good pharmaceutical, and then going home. I think it'd be more convenient than going to an urgent care facility or a hospital. So overall, CVS is trying to break away from just being a retailer and really being a healthcare company. I think that strategy is a good idea. They announced their earnings today, and I wanted to go through the new information they provided, update my valuation on CVS, and then make a decision whether I should buy more shares, hold, or sell my shares in CVS. Let's take a look at the fundamentals, and then I'll go through a full evaluation of CVS. Let me share that with you. CVS is a $73 billion market cap company, and they have a lot of revenue. It's over $360 billion per year. That's a lot of revenue. And they have nice net income of $7.3 billion. They have a very low PE of 10.24, and their forward PE is even lower, under 8, which is really, really incredible. The dividend rate is pretty attractive at 4.56%. Analysts, several of them cover it, and they think it's discounted by about 28.66%. If you look at the company's performance, they haven't had a great year with regards to their stock. Year to date, it's down 26%. More recently, healthcare has seen a rise. As we head into potentially a recession, the healthcare sector is a good sector to invest in because no matter if we're in a good economy or a bad economy, people will go to the doctor if they're sick. So they've seen a little bit of a rise in their stock. After announcing their earnings, the stock is pretty much flat. It hasn't really done much, which is meaning that investors are not overly excited, but they're not going to sell it off. Looking at their financials, the company has been growing their revenue, which is good to see, just year over year growth. And I'm a little surprised that the stock has performed as bad as it has, because one of the metrics that I look at is revenue and revenue growth. If revenue is growing, that means the company is doing something right. They're probably selling a product that a customer appreciates. Customers are happy with the company. These guys they have a product that's desirable or a service that's desirable. So it's a little surprising that the stock has kind of gone in the opposite direction to their revenue growth. What's made CVS attractive to me is their free cash flow. For many years, they've provided really high free cash flow, but the recent years, cash flow has dropped. That might be the reason why the stock price has been suffering. And this year, it's expected that cash flow will be quite low. And I'm going to use a low figure in my valuation of CVS. If they can come back to that 13 billion plus free cash flow rate, I think the stock will really head up. I did a valuation on CVS by discounting the free cash flows I expect the company is going to produce in the future, and also looking at their earnings per share and then valuing the company based on earnings per share. I get to a blended discount of 30% on the CVS stock. That's a pretty decent discount on a very well-known name. Let's take a look at cash flow and how I got to a discount on cash flow. So the guidance for the current year, they updated it in their earnings, and I used a $6.3 billion figure, which is quite low. And then I'm growing the cash flow by 10% in the first 4 years, and then terminal value would grow by 4%. I think this forecast is really conservative. If they get back to that 13 billion plus rate, this really changes it to the better, to the upside. But I'll be conservative. I'm also being conservative with the discount rate, 9%. This is a well-known name, but their balance sheet has accumulated some debt. They acquired Aetna. They're carrying a higher amount of debt than they did traditionally. So I'm going to have a higher discount rate on CVS. I'm going to add the cash in short-term investments, and I'm going to take away debt to get to an equity value that I believe all those free cash flows are worth. And that amount is $90.7 billion. Compared to the current market cap, it provides a 24% discount if we look at free cash flows. And earnings per share was toned down a bit. I'm going to use the toned down earnings per share that we expect for 2024. Use a very low PE of 12. They've been a growing company. It is surprising that their PE is so low. It must be the sentiment on the stock is just so low. I'll use a low PE ratio, although I think they probably deserve more like an 18. And they are going to grow those earnings per share. So it gets a really nice expected value of the stock of $82 compared to their current stock price. It provides a 42% discount. A lot of analysts agree that the company is discounted, that it's a buy. So I'm right there with them. Blended, when I blend the two and I put more weight on free cash flow, it has a 30% discount, which is attractive on a well-known name. How desirable is the CVS company and their businesses? Well, let me make that decision. Ideally, I like businesses that are operating in the green quadrant, which is a quadrant that includes companies that have really strong barriers of entry to their competitors. Competitors can't come in and compete against those companies. It could be patents that keep a pharmaceutical exclusive to a particular drug. It could be software where that software is just the best and customers want it. There could be a lot of variables there, but it gives those companies huge advantages. Let's see. And in the gray, those companies are potentially good companies, but they have competitors and they have to compete every year. In the red, those are businesses that have too many competitors. They're probably on really old industries where the competition is excessive, profits are low, free cash flows are low, or maybe even negative. I don't like buying in the red. CVS is really in the gray, but I like that they're investing and have a business as being a healthcare payer and insurance company. It gives them a lot of cash to work with, and they're making themselves different. They're not just a retailer. You could say that they are more of a healthcare provider. So with that, I think they're moving a little closer into the green. So I'll give them a slight, percentage of their business in the green. If they continue to do well in having that combination of being a healthcare payer, a healthcare provider, and a massive retailer and pharmacy business, they may become the Walmart of healthcare. That might be a very powerful position to be in. So I like what they're doing with their business. Having said that, I make a decision to buy, hold, or sell based on three areas: the company, the balance sheet, and the discount. The company, I like what CVS is doing. I like that they're really growing and expanding beyond just being a great pharmacy business. So I like the business. The balance sheet, although they have more debt, you can account for that debt. They acquired a big entity in Aetna. They continue to generate cash flow so they can pay off that debt. So although the debt provides a debt to EBITDA ratio above 3, I'm going to give them a pass on that for now. The discount, it's a good discount. I use very conservative figures in my valuation. Having a 30% discount is, I think, worthy of me buying more shares. So I'll be buying more shares of CVS and continuing to grow my position in this healthcare company. It's not a bad time to be investing in healthcare, so I'll be glad to buy more shares. I like that dividend. That steady income will really be nice, especially as we operate in a declining market. The month of August so far has been a tough month for stocks. Stocks have gone down in value quite a bit. So that's my evaluation of CVS. I hope you found it interesting. Just a reminder, I'm an individual investor. I'm not offering any financial advice. Please buy, hold, or sell CVS independent of this video. I appreciate you watching. Good luck investing in 2024.